Welcome back, everyone, to Capital Conversations. We go live every Thursday to chat about topics that will help you level up in real estate. And today I want to dedicate this episode to limited partners. Now, for those of you who don't know, limited partners, passive partners, accredited investors, there's all sorts of various names that folks who are investing passively in deals might go by or might be referred to by. So I want to dedicate this episode to folks who are limited partners or, passive investors, because I feel like there's a lot of content that would be very beneficial for them. There's a lot of content out there specifically for general partners. There's a lot of content for people who want to buy real estate and want to operate real estate, but I don't think there's that much content out there for people who want to invest passively in real estate and want to do it in a way that they feel confident in, that they feel safe, that their money's being handled effectively, and that they feel like they have a good amount of knowledge in what they're doing. There's not a lot of content dedicated to preparing those folks for investing in various real estate ventures, whether they might be flips, they might be mobile home parks, apartment complexes, ground up development, office complexes. There's so many different things. It could even be oil and gas. It could be anything. There's a lot of different products that people who are passive investors invest in. And so I think it's really important for us as operators and for limited partners, folks who are looking to invest in real estate. I think it's really important for us to chat about what are some of the considerations that would be really helpful to know going into something. What are some things that I should understand? How do I know that someone's going to take care of my money? How do I know that they know how to operate a deal? How do I know they know their stuff? How should I vet them? There's a lot of questions that run through people's minds before they invest either in real estate generally, but also with a person, with a company. And so I'd love to talk about some of those topics. And specifically, I'd like to talk about the capital stack and why you should care. Why should I care about the capital stack? What is it? Where can I find it? There's all sorts of topics about the capital stack that we'll chat about. And I think the first thing I want to talk about is, what is it? So I like to visualize a capital stack exactly how it might be thought of. It's a stack, right? I almost think of it actually as a pyramid. That's one way that I love thinking about it. So at the bottom of the pyramid, that is where it's essentially the most secured. And the bottom of the pyramid also typically has the lowest returns. And who occupies the bottom of the pyramid? What is it called? That is called the senior lender, or first position debt. Now, the person who holds the first position debt, like I said, they're typically the most secured. And the reason for that is typically they have some sort of mortgage, they have some sort of security against the property, to the point where if someone doesn't perform, then they go back, they take the property, and now they've got some sort of collateral. And that gives them somewhat of a safety net. But it also makes it so that they typically have lower returns. Now, if you think about, what does the bank charge? Well, typically a senior lender, a bank, maybe it's a debt fund, typically they might charge an interest rate, could be 12% even if you're looking at maybe hard money lending. Maybe it's a local regional bank and they're charging 8%, 7.5% on a 20-year amortization. So typically their interest rates are, 8%, and they're getting that money from somewhere. So they have to pay out some cost of capital as well. So they're not netting that full 8%. Now, when you think about it, that means that their return is fairly low, but it's because they have a position of security. They have a security against the property in the form of a lien. And that lien might be a mortgage, like I mentioned, but that gives them an ability for some sort of recourse in case, something doesn't perform with the property. If payments aren't made, then they can take that back. That is what exists at the bottom of the capital stack. That's where the banks are. That's where the hard money lenders are. Those are the folks who have a lien against the property, and therefore they're taking a lower position on that pyramid. Now, after that, and this is where it can get kind of complicated, a bank is involved in most real estate transactions. So you may have, a bank, you may have a hard money lender, you may have folks who are funding the deal in first position. Then you also have something called mezzanine debt. And this is where it gets a little bit out of hand for single family. If you invest in single family, tune this out. You don't have to. This might actually be applicable. And this is why you should care. Because mezzanine debt it comes after the senior lender. Mezzanine meaning middle, right? You're in the middle of the pyramid. And so the mezzanine debt has a position behind the first position. It might be second position, it might be third position, depending on what you're getting. But the mezzanine lender is also going to have higher returns. So maybe you've got 12, 15% as a mezzanine lender. Maybe it's a private money lending position, maybe it's something else. But typically they're behind that first position lane, and they typically have a higher percentage interest rate as additional incentive to be at that part of the capital stack. Again, they're a little bit higher. There's a little less security in terms of they're behind that first position, but they're getting compensated for that. And you'll see that trajectory continue as we continue talking about going up further in the pyramid. You'll see there's a little bit less in terms of, I don't want to call it guaranteed returns, but in terms of the amount of certainty of the returns, it does increase as you go further down the stack. But because of that, your amount of the return is also going to decrease. You can think about it in this way. If you're very familiar with the stock market and the bond market, what do stocks and bonds do? Well, typically, especially if you're buying government, treasury bonds, if you're buying bonds, the certainty of that return of that dividend is going to be fairly high. And therefore, typically bonds are lower in return. You may have a junk bond that is going to pay higher potentially, but again, the more uncertainty there is, the more you're getting compensated for that. So that's what it looks like from a stock and bonds perspective. Now, stocks, again, you have more volatility in stocks. And because of that, with the volatility, that also allows a degree of upside for there to be within that transaction. So stocks, you may buy Nvidia, and Nvidia may explode and it may go through the roof, and you may see that upside. You're not going to see that in the bond market. You're not going to see the wild trajectory, the ups and the downs, but you're also going to be pretty stable, pretty steady. And so that is how you might equate it in the pyramid, the capital stack. You may look at higher up the stack as a stock and lower on the stack as the bond, as if that makes more sense to your brain. But that's one way to visualize it. So think of the capital stack. You think of this pyramid. At the bottom, you've got the senior lender. You've got first position lane. And in the middle, you've got mezzanine debt. That's second position lane. Then you've got in the upper middle something called preferred equity. And again, this is something that is more common inside of the syndicated real estate space. It may be in the business acquisition space. Typically, these are more sophisticated operators, folks who are looking for a higher return, but on the equity side. Now, I have to stop because when we're talking about the capital stack, there are two differentiations I have to make. There is something called a debt, and there's something called a portion of equity. And just to give you the difference between the two, a debt is you loan me $1, now I owe you $1 in interest. Equity is you're buying a percentage of my company, and now whatever upside in that company there is, you're going to see a part of that. Now, there's different ways to structure equity, and there's different ways to structure debt. But with equity, there's something called preferred equity, which is below, and I'll get to this in a little bit. Above it is common equity, and below it is called preferred equity. And preferred equity, you'll notice, is lower in the stack. There's a little bit more certainty in terms of the returns because they get paid before common equity. Common equity gets paid at the very, very end, and preferred equity gets paid first. So they're a little below the top, but they're also a little above the bottom and the bottom middle. So if you're looking at the capital stack, it's really a list and an order of who gets paid first. Well, when you sell a property, the bank is going to get paid first. Then if you have any other contractor liens or anything else like that on the property, that's going to get paid. Then if you are an equity partner in that deal, especially if you're a preferred equity partner, then you're getting paid on that preferred equity. And then there's common equity, which again, we'll get to. But preferred equity, now we'll talk about accrued versus paid current. And accrued preferred equity essentially means over the course of the year, let's say maybe we've got a preferred I'll break down what's called a preferred return. So a preferred return, sometimes it's advertised as you are guaranteed this amount. That is a myth. That is false. It is not true. Just because you're getting a preferred return, let's say your preferred return is 8%. A lot of people may look at that and they may say, "Oh my gosh, wow, I'm making 8%. That's way more than I can make in a bond. It's way more than I can make in the savings account. It's more than I can make on dividends. This is great. 8% is good. I'm going to get 8%. I'm going to get 8% every year until this deal sells." Not necessarily the case. Preferred return means that you're getting paid before the common equity and after the debt. So it may be the case where the cash flow can only support paying you 4% until that deal is at a certain level. Because very often in deals, what operators do is they buy a deal that is not performing, and then they take it to another place and they make it much better, a better performing asset, more cash flow. And in that period, you can see maybe it's not performing right now and there's not a lot of cash flow. And later, it is going to cash flow very well. Well, in that period, it may not be possible to pay out an 8% preferred return and pay the mezzanine debt and pay the senior lender. So really, what the main concern is making sure the debts are paid, the lower part of the capital stack is paid. And then once those are paid, then you pay the preferred equity with the cash flow that is left over. That's kind of how that stack works. And so with that, there is also an incentive still to be preferred equity, because with preferred equity, you're able to get a potentially higher return than mezzanine debt and then the senior lender. So the two bottom layers, you're able to get a little bit of a higher return, and it still has a greater degree of certainty than the common equity at the very top. And you may also have the ability to enjoy some of the upside. So you're not just potentially getting a fixed 8% return consistently. Maybe you're getting that fixed 8% return after a couple years as the project's been stabilized. When I say stabilized, that basically means we're buying it in one state, we're improving it, and then we're making it a viable, self-sustaining project, on the end. So you have that preferred equity position that gives you the 8% before anyone else gets paid on the common equity side, whether it be the sponsorship team or limited partners that have common equity. But it gives you a little bit higher return than if you were to just give debt to that project, and you're still able to see some of that upside. So that's how that preferred equity works. Now, we'll talk about a deferred return or accrued. So essentially, let's say for preferred equity, again, cash flow only supports paying out a 4% preferred return at the beginning because there's not that much cash flow in the beginning as the project's getting stabilized. Well, that doesn't mean that the other 4% is now gone. I only made 4% this year. Darn, I'm never going to get that other 4% back. What happens is that 4% is then accrued, meaning it builds up over time, so that next year you're not going to start with trying to pay the 8%. You're going to start with trying to pay the last 4% from the first year. So you can see how it accrues, but also as the project improves, then there's additional cash flow, which allows you to pay that 4% in arrears, meaning behind. The 4% that was accrued in that first year, you're now more able to pay it in that second year, in addition to the 8%. So really what that depends on is the operator doing a great job with operations? And are they improving the cash flow to the point where then you can pay out not just the preferred return in arrears, but also the preferred return current, the preferred return from that year. So you can see how while there is a little bit more uncertainty or a little less certainty, again, as you're going up, there's still that element of, hey, I'm getting paid first before X class, which would be the common equity, which is, again, next. We'll talk about that next. But with the preferred equity, you're building it up over time, over the course of the asset, and you're able to enjoy that preferred return, whether it's 4%, 8%, whatever it is, before any other asset classes of investment within that particular asset are getting paid back. So that's how that works. Now, let's talk about common equity. And this is where, when most people think of equity, this is what they really think of. They think of ownership in terms of upside. So you're seeing the upside on the valuation, you're seeing the massive upside on the cash flow depending on the project. And when you're looking at the equity position, again, it's paid last. So that means that you have to execute on paying the first lien position, on paying the bank. You have to execute on paying the second lien position, whether that is a line of credit, maybe that is some sort of other private money lending that's in second position. Then you have to execute on paying the preferred return. And then finally, if all of that is paid up, then the common equity gets their slice or their share of the pie. And that share of the pie is typically bigger, again, because there's less certainty as you move up the capital stack, up the pyramid. And so common equity, that is where the general partner exists. That is where the limited partners who have common equity also exist. So they see an element of the upside as well. Typically on syndications, it's about 70% of that upside of that equity belongs to the limited partners, belongs to passive investors. And so that's a little bit where the incentives are aligned for sponsors, for the folks who are general partners, the folks who are doing the work on the ground, and limited partners, accredited investors, the folks who are sending the money in and they're receiving quarterly dividends or they're receiving the upside. The part where their interests are aligned is both in the preferred equity, but also in the common equity, because the sponsors want to make sure the preferred equity is paid out so that they can see their slice of the common equity. And then also, the limited partners are seeing the upside in the common equity along with the sponsors, which means that both benefit as the project's value now increases. Most of the time with limited partners getting 70, 60%, whatever it might be, sometimes up to 80%, depending on the project and the needs of the project itself. But that's how the capital stack works. At the very bottom, you've got the bank. And at the very top, you have the people who are doing the deal, either the people who have invested money and are seeing the upside, or the people who are doing the work on the ground, that are turning the property around, developing the land, whatever it might be, the people who are leading the project. That is where most of their return comes from. Now, they may have a little bit in the preferred equity side of things. If they're investing their own money, maybe it's more. If they're investing mostly their money, but that is how that works. And you can see how it goes from highest certainty, lowest reward to lowest certainty, highest reward. So that's how the capital stack works. Now, why should you care? I broke out a lot of stuff. Why should you care about all that? Well, it tells you really in terms of where is my money being prioritized in terms of being paid back. Obviously, investor equity is top priority for sponsors to pay back before they get paid themselves. But before that can even happen, they also have to pay back the bank and they have to pay back any other debts that might be incurred on the property. So while it may be the highest priority for sponsors to pay back the investor equity, you're also seeing instances where now, especially as there are a lot of assets that are quote unquote underwater, there are assets that are worth less than the bank debt. Well, that means when you sell the asset, the bank has to get paid first. And if the asset is not worth more than what the bank owes, what is owed to the bank, then the investor equity is not getting paid back. And so that is why you should care. If the asset is not worth the debt that is on the property, that means that the equity that is there is completely wiped out. And that is why it's so important, and we'll transition into the next topic. That's why it's so important to understand underwriting and to understand sponsor management and sponsor validation, sponsor evaluation. Essentially, you want to make sure that you're working with really good sponsors and you want to make sure the deals that you're looking at are very good. So this is why underwriting is the most important pre-close activity. This is why underwriting is the most important pre-close activity out of anything out there. There's, of course, due diligence, but I would wrap due diligence into underwriting. I'd say Everything in your underwriting should reflect what is in your due diligence, whether it's the condition of the property, whether it's the condition of the financials, whether it's how much you need to actually put into your construction budget. All of that from your due diligence is going to impact your numbers in the underwriting, and you should see that, and you should see the probability of what are rents going to do in the near future. Now, that's where a lot of sponsors unfortunately got caught in this most recent cycle, part of the cycle, is there's a lot of short-term debt. There's a lot of betting and guessing that rent growth is going to increase rents are going to increase continually by 10% year over year, or 6% year over year, whatever it might be. That is just not sustainable over the long term, not economically from a macroeconomic standpoint, and not personally, not for individuals. Individuals can't afford to pay 10% more in rent every single year for 10 years or 5 years, which is the typical hold time for a real estate syndication. It's not feasible. People aren't getting 10% increases in their salary. And so underwriting to that on a continual basis, having the expectation that year over year rents are going to increase by 6% or 10%, you're going to see a lot of vacancy. And that's exactly what happened. And unfortunately, that happened in conjunction with a lot of loans coming due because they were on short-term time periods. Now, I've talked about the loan part a lot, but what I really haven't talked about so far is underwriting. Why underwriting was so important and why it was missed, and why some of the experts, some of the really experienced limited partners and some of the really experienced investors who have been putting their money into deals, they've seen it coming. The folks who had their money invested in deals in 2014, and they'd seen, interest rates driven down periodically and pretty drastically over the 14 years after the 2007 financial crisis. They saw where the economy was heading. They saw that we were entering a tremendous period of growth, and that growth was sustained for a long period of time. And it started to ring alarm bells in a lot of their brains. And I remember when I was getting started in 2021, I was buying fourplexes and duplexes and houses. I was speaking to someone who's become a mentor to me, and he advised me, and he said, watch out, because interest rates are not going to stay here, and when that happens, when they do change, it's going to leave a lot of people hanging, so watch out. And that's not guessing. He wasn't just guessing that interest rates were going to rise. That's the only place that they had to go, because they were essentially at zero. And when interest rates are zero, then that causes the economy to heat up very drastically and very quickly. And then you have to slow it down by increasing interest rates. And so that's exactly what happened. Not more than 2 years after he said that to me, 2023, it was very, very quick, and it was very shocking for a lot of people. But in the meantime, this gentleman who's been in the real estate industry for decades saw it coming, and he put it into his underwriting, and his deals are performing very well. And so that is why it is so important, and that's why it's so important for limited partners to understand and see this underwriting and be able to understand it, or to have someone on their team who's an advisor to them, is they're able to see, is this rent growth estimate out of whack? Is this crazy? Is this estimate for the cap rate not in keeping with any of the other sales in the area, any of the other properties that have sold around here? Is this truly a comparable sale? You're able to determine some of that through the underwriting, a lot of that through the underwriting. And you're able to see, are these comps actually competitive? Are these rents that we're looking to charge after we've done all this renovation actually feasible? Or is this where we're shooting for unproven rents, and we are trying to prove out our model with rents that we just have not seen yet, because we believe that our product is going to be superior in some way? Well, you're going to need some proof, and that is seen in the underwriting, and it should be shown in the comparables that are shown to limited partners, and there should be the ability for folks to really see and investigate and check out for themselves pre-close. Do I believe that this business plan is viable? If I do not, then I'm not going to invest in the deal, but I need to have the ability and the information to see whether or not these assumptions are viable. And so when I'm looking at underwriting for the limited partners out there, for the folks who are wanting to invest money in deals, here's what I look at. I look at a few things right off the bat, and I've already listed a few of them. But I look at a few things right off the jump to make sure that the deal that I'm looking at isn't some pie in the sky projection, some spreadsheet magic that is designed to get me to invest money in a deal. And here's a few things that I look at. I look at what is the rent growth assumption. If the rent growth assumption is 10%, if the rent growth assumption is 6%, if the rent growth assumption is 5%, I'm looking at it and I'm thinking this has a major, major impact on the valuation of this property, whether it be for a refinance or whether it be for a sale. If you're projecting that rents increase 5% year over year, and you're doing that for 5 years versus a more standard 3% or sometimes even 1%, depending on which part of the country you're in, projection, that difference is astounding as it compounds. You're going to see, if you guys plug that into a calculator and you see the difference over 5-10 years between rent projections of 1% and rent projections of 5%, you'll see how massive of a difference it makes to assume a difference in rent growth. So that is one of the first things I look at. Is the rent growth assumption egregious? Is it something that is not feasible, not likely, not probable? Yes, no. If it is no, it's probably not probable. It's not probable to have this level of rent growth. I'm going to stop right there. I'm going to check with the sponsor, try to get an explanation. What is going on here? I don't really believe this. I'd ask a lot of questions, and I'd get them to show proof. I'd get them to figure out, where did you come up with this? Where is this rent growth assumption coming from? Now, there could also be the argument, of course, as I'm sure a lot of folks had when they were investing in 2021 and they did see tremendous rent growth in, say, Austin, Texas. They could say, well, we have historically in the past few years seen rent growth at this level. Then it comes to the limited partner to have their thinking cap on and to think about, is this sustainable? Is it truly sustainable to have 10% rent growth over the next 10 years? Or is that something where that really doesn't make sense? It doesn't track with wages. It doesn't track with cost of living. There is a level of due diligence and a level of scrutiny that I think every underwriting it has to take. It has to withstand. And that's why I always share my underwriting personally with my investors, is because I want that level of scrutiny. I want them to ask questions, and I want them to be curious, and I want them to pick things apart, because if my investors are finding something that I'm not, then that's a red flag for them and for me. That gets me to double check and make sure, where did I get these numbers from? Now, I always include notes inside of my underwriting to show, hey, here's a hyperlink to where I pulled it from. This is an actual quote from the utility company, or I got this from the county assessor themselves. I talked to them on the phone. I always include that in my underwriting. But I always invite scrutiny of that underwriting, because that just proves a little bit more to me even that, hey, it's gone through the eyes. I've had folks outside of myself look at this, and they've also taken a look and asked the questions that they felt were necessary to ask, and got the confirmation of various numbers that were necessary to confirm. I think that's so important. And so that's where I would start, bringing it back. I'd start with rent growth. And I'd look at, is the rent growth assumption feasible? Is it viable? And is it sustainable? After that, I would look at the cap rate. So for those of you who don't know, a cap rate, capitalization rate, I'm not going to go super into detail. That may be a different podcast. But I look at cap rate as almost a multiplier for what is the property going to be worth based on the comparable sales of other properties in the area. Now, there's a lot more to break down. That's a very simplified way of looking at it. But when you look at The equation itself, and I'll give it to the limited partners because I think this is very important to understand. When you're giving a valuation on a property, this is how the equation works. You look at the net income, so that's income minus expenses, all income minus all expenses, and you divide that by what's called the cap rate. Now, that cap rate might be 7%, 8% if you're investing in Iowa. It might be 6.5%, and if you're investing in parts of Arkansas or Dallas, it might be 5% if you're 4%. Even if you're investing in Los Angeles. I've never invested in Los Angeles myself, so I cannot speak to it fully. I have heard stories of 3%, but that is not an area that I personally look at. So if you look at the equation, then you're dividing the net income by the percentage cap rate. And if you just plug that into your calculator right now, you may take 100,000 and divide it by 0.08, which is an 8% cap rate, and then try dividing it by 0.07. Then try dividing it by 0.05. Then try dividing it by 0.03. And you'll see it changes tremendously between each of those. So one number on your spreadsheet can have a huge impact, even more than the rent growth, can have a huge impact on the valuation of a property. So this is one of the things that I check to make sure, is this a viable assumption? Is this something that makes sense and is supported by data? So I always want to make sure not only is the cap rate likely, and this is one way for you limited partners and accredited investors and folks who are investing money, can make sure that the cap rate is correct or at least viable. You can talk to brokers in the area and you can talk to other investors in the area who are familiar with the market, and you can ask them, hey, I've got a deal in middle of nowhere, Illinois, and they're saying we can exit at a 4 cap. Does that make sense? Now, if anyone invests in Illinois at all, any part of Illinois, Chicago to rural Illinois, they will tell you a 4 cap is nonsense and you should run from that deal. Again, you're probably looking at more of an 8 cap. Maybe it's a 7.5 cap or a 7 cap, depending on the population center. But a 4 cap is ludicrous. And you'll see the difference between the cap rates, again, if you go through that exercise that I mentioned earlier. But that's one way that I would check, is I would talk to local investors, I would talk to local brokers, and I'd even check out a bank. I'd talk to local banks in the area and see, what do you underwrite the cap rates at for properties, multifamily properties in this area of this age, in this specific zip code? I'd ask them, because the more data points you have, the more likely it is that you'll end up in the area of probability for the cap rate. So that's where I'd start with cap rate, is number one, verify where the likely cap rate will be upon the exit. Then I would also look at, is the sponsorship team, or the people who are bringing you the deal, are they saying the cap rate is getting higher or is it getting lower over time? Again, if you go through the exercise, you'll see a lower cap rate will increase the value. So if they're decreasing the cap rate over, let's say, a 5-year hold, they're saying it will not only be more valuable because we're doing something to it, but it will be more valuable because the market is more valuable and inherently more desirable than when we first bought it. Now, the conservative way to run the numbers is to do the exact opposite. The conservative way to run the numbers is to say, over time, the cap rate is going to what we call decompress. So the cap rate is going to actually increase, decreasing the value of the property. Now, there's a lot of increase, decrease. It might be getting a little confusing. But just to kind of wrap that up, essentially, the proper, or the conservative, I'll say, way. There are various ways to underwrite, but the way that I look at underwriting to make sure that I'm giving my investors the most conservative look at this property that I can provide is to make sure that over time we are decompressing that cap rate by about half a percentage point over a 5-year hold, so about 0.1% over that 5-year hold. And again, that's to make sure we are projecting that the value of the property inherently, from the market standpoint, is going to go down in terms of that multiplier. It's going to be less effective over time, that rather than more effective or stay the same, to give us more of a cushion, a buffer. Because let's say the cap rate stays the same and we increase it by half a percentage point, it's going to make the deal a lot better. Let's say the cap rate gets better. It's going to get a lot better if we increase it by half a percentage point. But let's say that it actually does, the market does become quote unquote less desirable, or the property itself is now getting older and becoming less desirable, and we underwrite to half percentage point cap rate increase, therefore making the financials on this project a little less valuable to the market and decreasing the value a little bit. Now, if we underwrote to half a percentage point cap rate increase, then we're on target, or maybe we're still even a little bit ahead. That just gives us a little bit more buffer. And for you as a accredited investor or limited partner, that's going to give you a little more confidence that this deal will hit some of the numbers that are being projected, rather than radically missing many of the projections. So I'd look at rent growth and I'd look at cap rate, and then I'd start looking at operating expenses. Now, this does get pretty into, I don't want to call it the weeds, but it does get a lot into operations, and it does take a little bit to verify some of these things. It takes some effort to verify the rents. It takes effort to verify the expenses and to look through what we call the T12s, the trailing 12 financials for the property, the income and the expenses. That takes a lot of time and it takes a lot of effort. And if you want to dive super deep into a property and make sure you're getting the best deal and they're doing all the underwriting correctly, then you can totally do that. But I think really what is more important is vetting, do I trust this sponsor to be thorough and to be diligent with the numbers and to care about whether they are both of those things? And do I trust them to put my best interest at heart? Not just have it in mind, but do they have my best interest at heart? Do they want to not only see this investment successful, but do they want to return all of my money? And do they make that a priority? I would start with vetting the sponsor first. And there's a lot of different ways to do that. You can ask prior investors how they were treated, how their capital was treated. You can look at their returns from prior deals if they publicize those. If they don't, then you may have a little bit more work ahead of you. But I would start with prior investors. And I would also, of course, have multiple conversations with the sponsors to see, do they align from a values perspective with me? Or am I investing with them mostly because I like the returns? And if it's mostly because you like the returns, there are a lot of ways to make money. And there are a lot of ways to lose money. And one of the ways to lose money is to invest it with people who do not have your best interests at heart. So I would just caution you as a limited partner, if you do not feel that they have your best interest at heart, or if you do not feel that they have the same values, I would not invest with that person, because I could just put that into something else and I'd have a lot more, a lot better chance of that investment going well than with someone who may not have that best interest at heart. But if you do have a sponsor that you find that you feel is trustworthy, that you feel has the same values as you, that you feel values your capital and wants to return all of it to you, then that person can give you substantially better returns than what may be available in the open market, whether it might be the S&P 500, whether it might be bonds, whether it might be even buying real estate yourself and doing all the work. If you can find someone who is competent, who is trustworthy, who knows their stuff, and who has deal flow and is able to execute on that deal flow, then they can give you very good returns. So I've talked through so far, what is the capital stack and why does it matter? Why should you care? I've talked about what is underwriting and why is it one of the most important pieces pre-close to a limited partner. Next, I'm going to talk about common investing strategies, and I'm going to leave it off here with that topic. And that's going to be our last topic, is common investing strategies. So there's a few things I'm going to talk about. And the first thing I want to preface with is I'm just going to talk about commercial real estate. There's going to be a lot of different investing strategies. I mean, there's wholesaling, there's house hacking, there's all sorts of stuff. And I've done some of these things and I've profited from them. But what I would really want to talk about here is commercial real estate, because it's my opinion that is what's going to be most beneficial to the limited partners and the accredited investors that are listening. Is how do you differentiate between some of these strategies? What are some of the risks? What are some of the benefits? What are some of the things to consider between each of these? So the first thing I would look at is, and we're not going to talk about asset classes. There's, of course, there's office, there's mobile home parks, there's multifamily. We're going to talk about more of the strategy level. What is the business plan for this? So, number one, I want to talk about is ground up development. And ground up development, you're building a brand new asset. Maybe you're entitling the land. Maybe you are going to the city and you're getting all sorts of building permits, and you're having a lot of these even pre-construction costs that are being associated with it. So there, in ground up development, there's absolutely some risk with that. But ground up development can also be one of the most lucrative pieces of real estate, because you're taking essentially one piece of real estate and you're completely transitioning it to another piece of real estate or another use. And there's a ton of value that you create between these two. And so with that, what are some of the benefits? Well, your return on investment is typically pretty high. For development deals, it might be 3 times your money, it might be 5 times your money. There's a lot of various investment deals out there that have various return structures, but typically you're looking at a fairly high return structure, again, because there's a higher element of risk with development in terms of all the steps that are necessary in order to get the project to completion and to sale. The next strategy I'll talk about is turnkey investing. So turnkey investing, very simply, you may be buying a fully stabilized asset. You may be buying an asset that is fully tenanted. There are no vacancy items. There's no deferred maintenance items. It's a fairly new asset. An example I might give actually plays off exactly what we were talking about. Maybe your group or you as an individual will buy a ground up development from a developer, and it already has all the tenants in it. It has brand new appliances, all new interior, all new HVAC, mechanicals, roofing, siding, all the fixins, right? All the different things that a property might have are pretty much brand new. They've just been put in there. You're, in terms of a management, maintenance headache or items or things to consider in terms of those areas, it's going to be the lowest effort out of those. You're probably going to have the highest class tenants. They're probably going to be class A tenants, very white collar, the folks that are going to be having a lot of disposable income and are probably some of the least likely to be late on rent or to not pay rent. So what are some of the benefits of turnkey investing? Well, number one, as I mentioned, you're going to have a lot fewer items in terms of management and in terms of maintenance. There are fewer costs associated with running the property in terms of repairs and maintenance, and in terms of kind of headache costs that's associated with turnkey, because everything's basically new and you have people who have the means to pay rent and to not fall behind. What are some of the disadvantages of turnkey investing? Some of the disadvantages of turnkey investing would be you're not really adding a ton of equity or a ton of value. It's kind of really the opposite of ground up development in certain ways. Ground up development, there's a lot of work that is associated with ground up development. There's a lot of work that's associated with just getting the property off the ground, and you're compensated for that through equity. You're compensated for that effort by taking it from one level to taking to another level. You might be making a large delta between those two, but your cash flow is going to be super low. You're going to have like no cash flow because it's not tenanted. There's no one in there. It's essentially cash going out the door every single month until the property's done. And then you sell it and you convert that equity into cash flow. Turnkey is the opposite. You're not building any equity in the property aside from your appreciation. You're not building any equity in the property because you're not adding any value to it in terms of various operational improvements. Now, you might be able to buy a turnkey property and improve the value of it by changing some of the operations. There are absolutely new developments that you can buy, and maybe they were not managed well because they were built by someone that didn't really know how to manage that asset class. And you go in and you change the operations, and now you have a brand new asset, and you've just built a ton of equity into it because you're just a really good operator. There are deals out there like that, and there are people taking those deals down, and those deals are very, very solid deals because you have very little management maintenance, headaches. And if you're a very good operator, you can seize the opportunity that's been left on the table. You can kind of squeeze the lemon a little bit more and get a lot more juice out of it. So there's turnkey. You've got cash flow because it's already fully tenanted, but you're really most of the time missing the equity because you're not building a ton of value into that. You're not adding anything truly different because most of it has already been taken care of, except for maybe the operational items. Now, there's something in the middle between development and turnkey, and that's called value add investing. And that's where I exist. That's where a lot of my investor connections exist. And what we do in the value add investing space is essentially we take old properties that have been mismanaged. Maybe they are outdated. Maybe they've got roaches. Maybe they've got water pipes that are leaking. Maybe they have bad roofs. But this is where essentially you're taking that property and you're completely turning it around, whether it's from a operational standpoint or a construction standpoint, from a maintenance standpoint. You're taking a property that's been neglected essentially, and you're again taking it to a new state, but you're not building it from the ground up. So you're going to have a mix between the two. You may be building a ton of equity, and you may also be building a lot of cash flow because you're working in the occupancy side of things. But you may not be building as much equity as the developer, depending on how they did, and the cash flow may not be as consistent as the turnkey because you're probably not buying it fully occupied, because that's where a lot of the value that you can push comes from, is essentially this asset is not optimized. For all my tech guys out there, the asset is not optimized. So you may have to, I'm not going to take that analogy any further. I'm not going to talk about like coding, tweak the coding, because I don't know anything about coding or tech truly. But you may have to tweak that. You may have to improve that asset and change how that asset behaves and change how the structure of that asset is, whether it's actually the physical structure or if it's the management structure. And that will allow you to push value at that property and see simultaneously equity growth and cash flow growth. So that's how I would differentiate between the three main investment strategies I talk about today. Is you've got your development, which is high equity growth, low cash flow. You've got your turnkey properties, which is high cash flow or medium cash flow and low equity growth. And then you have your value add properties, which are anywhere from low cash flow at the start and high cash flow to the end, to low equity growth at the start, high equity growth at the end. It very much depends on your operational efficiency and your ability to execute upon your business plan. All of these do, except for turnkey, rely tremendously upon your ability to execute. And so the final word I'd say to limited partners is just make sure whoever you're investing with has that ability to execute, has people on their team with the expertise and the knowledge and the track record of that execution. Okay, folks. Well, hey, this has been another Capital Conversation. I'm AJ Smith. I go live every Thursday around 6 Central Time. Thank you all for joining me. I hope you all enjoyed this Capital Conversation. If you have any questions, feel free to leave them in the comments. If there's anything that you wanted to learn that you feel like you've not learned today, send me a DM, drop a message in the comments. I'd love to answer it. Until then, and until next time, have a great day, and I will see you next Thursday. Take care, everybody.